Hello everybody, it's Yashar here, back again with another video. And in this video, I'm going to diving deep into the Canadian telecommunications sector to analyze the four biggest players: Telus, Bell, Quebecor and Rogers. The oligopoly of Rogers, Bell and Telus control over 90% of domestic telecom market, while Quebecor is growing relatively faster as the fourth emerging telecom company here in Canada. Most of these companies are not actually in a good situation with their share price and their balance sheet, and they are underperforming the market in the last 5 years. We will be looking at the recent developments, future outlook, and answering the big question: what is the fair value of these telecom stocks in Canada and whether they are a buy today? The Canadian telecom market is a fascinating one. It's dominated by these four companies which formed an oligopoly over the market, as any new competitors face significant barriers to entry and massive infrastructure investments. For investors, these stocks are often seen as defensive dividend plays due to their consistent high dividends and relatively stable revenue streams. However, the landscape is evolving, with 5G rollout costs, increasing competition, and shifting consumer habits. Pretty much all of the telecom giants are lowering their prices to stay competitive, which is awful for their margins and growth prospects. And that's the main reason all of these stocks are underperforming the market in the last 5 years. Okay, first let's take a look at Telus. I analyzed this stock in the past in my channel. In March of 2023, I analyzed Telus Stock when the stock price was around $26.80 and concluded that the stock was overvalued and the fair value was closer to 24 Canadian dollar for a 10% return. I even mentioned these in a comment in that video about future returns of Telus stock. Upside potential is not enough for me at these levels. I switch providers every single year, Telus to Bell, Bell to Telus. It's unbelievable that they don't offer you a discount for being loyal and rather offer the discount to you once you leave the company. And then I mentioned, in my opinion, the dividend is the return with Telus. The most important issue is their efficiency with capital allocation. High debt and dilution plus weak capital allocation equals lower expected returns, which is what we see with the performance of a stock in the last couple of years. Okay, today the stock price is $22.60 and the stock is flat in the last 5 years, which means the previous analysis that I had on the stock was actually correct. The only return you could expect from the stock was the dividend, as I mentioned. At the same time, the analyst price target for Telus was 32 Canadian dollar, which show you how much the analysts were wrong about Telus. Telus has a market cap of 34 billion Canadian dollar and they pay a dividend with a starting yield of 7.6%, which is absolutely crazy. I will talk about the dividend more, but let's focus on the business first. Telus has been diversifying its business beyond traditional telecom services, with significant investments in Telus Health, Telus Agriculture, Telus Security, and international business services. While diversification can result in a slightly better revenue growth, it also comes with execution risks and more debt for the company. For Telus, maintaining average revenue per user and managing regulatory pressures are ongoing challenges, and I personally don't think Telus is in a better position today than 2 years ago when I performed my previous analysis. They have to compete with Bell, Quebecor and Rogers in key markets in Canada, which resulted in losing their pricing power and reducing their margin. I still think what I said in my video 2 years ago about Telus business is correct. Their main challenges are their lower return on invested capital and their huge long-term liabilities. I personally believe that even the dividend is not that safe with Telus, and they probably have to cut the dividend if things doesn't change fast enough, exactly like what happened with Bell. At some point, if they cannot have a turnover in their profit margins, particularly when we look at how much they are diluting shareholders by issuing new shares, they have to do something to save their cash flow. To see how viable the dividend of Telus is, we should look at their free cash flow and their dividend payout based on the cash generated from operating activities. This is generally a more appropriate matrix compared to the earnings for evaluating dividend sustainability for telecom companies, as free cash flow represents the cash generated by the business after accounting for capital expenditures needed to maintain and grow the operations. In recent earnings report, Telus quarterly dividend is raised to 41 cents per share, while the free cash flow per share is around 32 cents per share. So the payout ratio is over 100% right now, and unless the company can significantly cut their costs, I don't think even the dividend is sustainable here, and they may have to cut it exactly like Bell. So especially when we look at their net debt, which is around 29 billion Canadian dollar, which is a lot considering their total revenue, and I mean revenue, not even cash flow, in a year is just 20 billion Canadian dollar at the moment. Anyway, let's look at my stock analysis on Telus using my personal discounted cash flow model and see what is the fair value of Telus stock today. So when I look at the model and the numbers, even with a relatively optimistic numbers, I cannot see Telus can return even 10% year over year with the current outlook. The stock fair value based on the model is around 18 Canadian dollar and 30 cents, and it is trading for over 22 Canadian dollar. So the stock is trading for almost an 18% premium based on the assumptions I put here. Now, if I reduce my expected rate of return from 10% to something like 8%, you can see that now the stock is fairly valued. So to me, if you expect to outperform the market, Telus is probably not going to do that over the long term, and you can expect the dividend to be your return at these levels. Second, we have Bell. This company once considered as the dividend king of Canadian telecoms with its strong focus on income investors. Unfortunately for investors in the company, Bell forced to cut its dividend recently. Bell annualized dividend fell 56% to $1.75 per share from almost $4 per share after the announcement of the management team at Bell. This was a major event for investors, particularly those who relied on Bell for consistent income, as the company had a long history of maintaining and growing its dividend, but years of inefficient capital allocation and strong competition finally puts its final pressure on the Bell balance sheet. The company said it made the decision to address pressures in its economic and operating environments that have been building since the fall of 2024, including heightened economic uncertainty, inflationary pressures, global recession fears, as well as what it called an unsupportive regulatory environment. Bell chief executive Mirko Bibic said on a call with analysts that the move will help the company optimize its balance sheet and cost of capital, accelerate the deleveraging, and give it flexibility to invest for growth. When we look at the current net debt of Bell, it is around 38 billion Canadian dollar, which is a lot considering their total revenue, and I mean revenue again and not cash flow, in a year is just 24 billion dollar. The other main reason that they had to cut the dividend is of course related to the competition, especially in wireless segment. Telecoms are highly capital-intensive businesses, and Bell has been investing heavily in expanding its fiber and internet footprint and rolling out 5G networks. They do this while they couldn't increase prices as the company simply didn't have any pricing power. This puts pressure on average revenue per user and subscriber growth of all telecom companies in Canada, including Bell. After all these investments and debts, Bell's balance sheet had become stressed due to ongoing capital investments and its dividend payout ratio. As a result, the share price of Bell is down 40% in the last 5 years, and they had to cut the dividend as well, which is an absolutely devastating performance for the shareholders of the company. Bell currently has a market cap of 30 billion Canadian dollar, and they pay a dividend with a starting yield of 5.79%, which is still pretty high. In terms of the valuation, let's look at my personal discounted cash flow model and see what is the fair market value of Bell stock today, and whether it is now represent a good buying opportunity. So when I look at this model and the numbers, again, I cannot see Bell can return even 10% year over year with the current outlook. The stock fair value based on the model is around 29 Canadian dollar, and it is trading for 32.5 Canadian dollar. So the stock is trading for an almost 9% premium based on the assumptions I put here. It's not super expensive, but it's not that attractive as you can see here. So to me, if you expect to outperform the market, Bell is probably not going to do that over the long term unless we see a major shift in the focus of the management team to reduce leverage, allocate capital wisely, and reaccelerate their growth. Next, let's look at Quebecor. Quebecor has historically been a strong regional player in Quebec, but its acquisition of Freedom Mobile in 2023 has fundamentally reshaped the Canadian wireless market and positioned them as the fourth national wireless carrier. This makes them a key force to watch as Quebecor's strategy is all about competition and value and pushing into new markets with aggressive pricing, particularly through its Freedom Mobile. And they are one of the main reasons that three other giant telecom companies are cutting their prices. Quebecor was the most successful telecom company in Canada in the last 5 years with 40% share price appreciation. Quebecor currently has a market cap of 9.5 billion Canadian dollar and they pay a dividend with a starting yield of 3.3%, which is much lower than that of Telus or Bell. But it is much safer in my opinion. One of the key metrics to watch for Quebecor is its debt leverage. After the Freedom acquisition, their debt increased, but they have been actively working to reduce it. Currently, their net debt is around 7.9 billion Canadian dollar, which is the lowest among all the Canadian major telecommunication providers, but it is still high compared to their annual revenue of just 5.6 billion Canadian dollar. In terms of the valuation, let's look at my personal discounted cash flow model and see what is the fair market value of Quebecor stock today and whether it is now represent a good buying opportunity. So when I look at the model and the numbers, Quebecor is actually trading slightly below its fair value. The stock fair value based on the model is around 43 Canadian dollar and it is trading for 41 Canadian dollar. So the stock is trading for almost a 6% discount based on the assumptions I put here. It's not bad, but it's not that attractive as you can see here, especially due to huge amount of the debt on the balance sheet of the stock. And software also gives me this warning about the debt level of the business. If I want to increase my margin of safety, I should put my expected rate of return to be around 12% for Quebecor, and in that case the stock is still expensive. But overall, I think Quebecor has a much better valuation compared to the previous telecom stocks. Okay, at last but not least, we have Rogers Communications. Rogers has positioned itself as a significant player in Canadian telecom market, particularly after its acquisition of Shaw, which has reshaped the market. Rogers' dividend yield was historically lower than Bell and Telus, reflecting a potentially more growth-oriented strategy. They showed this by completing the Shaw acquisition, which has been a major asset for the company, but it also brings significant debt to Rogers' balance sheet. Rogers is actively working to reduce its debt to EBITDA ratio, and the success of Shaw integration and effective net debt reduction are critical for Rogers' long-term performance. Rogers currently has a market cap of 18 billion Canadian dollar and they pay a dividend with a starting yield of 4.9%. In terms of the debt, currently their net debt is around 47 billion dollar, while their revenue is only 20 billion Canadian dollar. Their debt level is outrageous in my opinion and something that Rogers really should look for, and if you want to invest in the company, you should also look for this metric. In terms of the valuation, let's look at my personal discounted cash flow model and see what is the fair market value of Rogers stock today. So when I look at the model and the numbers, Rogers is actually trading below its fair value. The stock fair value based on the model is around 36 Canadian dollar and Rogers is now trading for 33.4 Canadian dollar. So the stock is trading for an almost 9% discount based on the assumptions I put here. It seems like Rogers is not a bad deal, but it's not that attractive as you can see because of the huge amount of debt of the balance sheet, and the software also gives me this warning about the debt level of the business. If I want to increase my margin of safety, I should put my expected rate of return to be around 12%, and in that case, the stock is slightly expensive. So overall, the Canadian telecom market is expected to see moderate revenue growth of single digits in 2025 and beyond due to market maturity and strong competition. All these four companies will be mostly focusing on cost management and cost efficiency to expand their EBITDA margin. I personally don't like this segment of Canadian market at the moment, Yes, there are oligopolies with significant barriers to entry, but these companies simply don't have any pricing power. As a customer, I don't have any royalty to these companies, and I simply choose the one who offers me the cheapest service. I recently changed my mobile plan from Bell to Telus subsidiary Kudo, as they offered me 30% discount for a year. I also recently switched my internet provider from Bell to Telus, as they offered me 50% off of Bell internet price. There is zero difference in the service I receive from Bell and Telus and Rogers. It's just a competition for lower prices. Interestingly, once I made the switch, I received calls from Bell to match the Telus offers. This is the race to the bottom, and for an investor, this should raise red flags about pricing power of the business and potentially future pressures on their margins. I personally would skip Canadian telecom market due to valuation concerns as well as future prospects, but based on the valuation we saw here, if I want to choose only one, I think Quebecor and Rogers are at a more attractive valuation compared to Bell and Telus at the moment, and I personally would choose Quebecor due to more growth potential and a slightly better balance sheet. Okay, what are your thoughts on Telus, Bell, Quebecor and Rogers? Let me know in the comment section below. Don't forget to like the video, subscribe for more stock analysis videos, and hit the notification bell so you don't miss our next deep dive analysis video. Thanks for watching, and I see you guys in the next video. Farewell.